All right, thank you for your time. Let's quickly continue the conversation from here. So take a look at major events that will likely shape the Nigerian economy in the run-up to 2019 election, and of course, post-election as well. And as we'll take a look at the holistic outlook of the Nigerian economy. And joining me to look at this issue is Johnson Chukwu, the CEO of Cowry Assets. Thank you for your time on the show. I really appreciate your time. Now, first, what do you suppose are the major events that we should look at for in the run-up to the election that may likely shape the Nigerian economy?
Well, the first thing is how the electionary activities go, whether the political parties will have the free hand or whether the electionary activities will be devoid of crisis in the nature of insecurity or conflicts. If the electionary activities are devoid of violence, then it should be a pointer that the elections may be free and fair. So what people are looking out for are indications or indicators as to confirm whether the election will likely be free and fair and whether the umpire will be neutral in the conduct of the election. And again, whether the political parties will accept the outcome of the election. Those are the factors that are shaping the economy in the next few weeks. And those are the factors that will determine how investors will behave in the market, in the market space. Reality is that as it stands today, most investors have already taken position as it relates to the elections. Foreign investors are pulled out of the economy, expecting to come back, hopefully, after the elections. Local investors are shifting or realigning their portfolios away from variable income assets, those assets that have the capacity to change the capital value, and they are putting their investments more in fixed income assets. The investments that they are guaranteed of principal repayment and some return on their investment. That's what is going on today. So, and that will play out until the end of the election. Then after the election, people will not be willing to take more risk. As it stands today, most investors are not willing to take a lot more equity risk, not just in terms of buying equity in the market, but also investing in real sector of the economy, putting investments in long-term assets while the clarity on the outcome of the election is not yet defined.
So for local investors, can we say there is something left for some of these local investors to take advantage of in the market, even though you said that most portfolio investors have pulled out of the market?
Yes, absolutely, for local investors, because our risk exposure is different from those of foreign investors. A foreign investor is exposed to the extent that there's also foreign exchange risk. Because if they are going to convert their foreign currencies into local currency, and they hope that when they want to exit, they can take back those funds and convert back to their foreign currency at some stable exchange rate. For local investors, we are not exposed to exchange rate risk, provided your assets are in Naira and your liabilities are also in Naira. So for such local investors, they're always bargain hunting opportunities at periods of economic uncertainty or political uncertainty. Take, for instance, in some areas, the equity sector I mentioned, quoted companies. You see some company stocks have gone down so drastically that investors see opportunity for bargain hunting, which has reflected in the market in the last few days, where people went back to the market to take advantage of bargain hunting opportunities. But beyond the equity segment of the economy, you also look at the real estate sector. We are seeing a lot of fire sales in the real estate sector. So for those who have liquidity, it's opportunity to get bargain hunting opportunity, even in real estate properties. And because you realize that a lot of politicians want to sell quickly to generate cash to continue with their campaign activities, and they're ready to sell at any going price. So those who have liquidity are in a position to take advantage of such fire sales and buy cheap in the real estate market. So periods of this nature, you see new opportunities open up, but it's basically opportunities for those who have strong risk appetite and have access to liquidity.
So what you're saying is that basically the real estate sector, it's where the fund it's going into now at the moment.
No, what I'm saying is that the real estate sector is presenting opportunities for people to go in, buy cheap, and then position and wait until after the election, and possibly want to sell, they sell and make good capital gain. In a sense, I'm not saying that a lot of capital is going there, but there are windows for people to go in there and take advantage of what is going on there. Because we've seen a sharp depression in real estate prices because of fire sales and the inflow into the market of so many properties for sale, while those who want to buy are very few. So that gives opportunity for those who have the liquidity and also can understand the market and have the appetite to take the risk involved in it. In reality, there will be few people who will take advantage of that because of absence of liquidity. Banks are not lending, so you're dealing with people who have their own personal equity to take advantage of this opportunity. But opportunities are there, which is the question. Do we have opportunities despite the depression in value of assets? Yes, they present opportunities for those who have liquidity and who understand the market and can take risk, both in equities and real estate.
Okay, globally, so what would you say is the position of the Nigerian stock market or capital market at the moment? Of course, I know that in 2018 there's a bit of volatility, that the market even declined to as high as about 17% year to date in 2018. So what exactly, of course, we've seen the first 2 weeks of this year, the market has been declining due to political uncertainties and some other factors you've said earlier. So what is the position currently globally in the equities market?
Well, Nigerian equities market the first month of this year had not done quite well. We started the market at a very bearish note. The market at some point lost about 6% year to date in the first 2 weeks of the month. But now the market has recovered to some extent. The year to date loss is just about 1.8%. But beyond that, the market itself presents bargain hunting opportunity that I mentioned earlier. And what happened was people went in for short-term gain, capital gain. And that was why we saw some rallies in the market. And if you now situate the market and looking at the outlook of that market in the coming months, we have to put it in the context. If you look back and recognize that in 2016, when the economy contracted, the economy lost 1.58%. The market only lost 6.7%. That's right. In 2017, the economy recovered and gained and grew by 0.82%. The Nigerian capital market gained 42%, which means people were able to take positions and recover whatever was lost in 2016. But now look at last year. The market, the economy, grew at an average of 1.7, 1.8%. Because if you look at what the first quarter growth was 1.95%, second quarter growth was 1.5%, and third quarter growth was 1.81%. So if you take an average, and we've not seen the print for the fourth quarter GDP growth, but my estimation in the economy will end up growing last year at about 1.7, 1.75%. But the market lost 17%. The equity market lost 17%. What does that tell you? It simply means that the investors' price in the risk associated with the political environment, the political risk in determining the equity prices. Where I'm heading to is that once that political risk is lifted from the horizon, from the economic horizon, then the market will recover because the market had suffered so much losses beyond the fact that the economy is not growing at a very fast rate. If it only lost 6.7% at the time when the economy contracted, the economy grew by 1.8% and they still lost 17%. The magnitude of the loss at the time when the economy even grew at 1.8% is higher than what is suffered when the economy contracted. So what happened was last year was a lot of the political risk was priced into equity prices. So in 2019, should we have a successful election and a government that comes in and is very serious reformation of the cabinet and comes up with a modified economic policy, the market will regain whatever it had lost last year. So I expect that the last 2 quarters of this year should witness a sustained bull run in the market if the politics is right and the economic policies are right.
All right. Let's quickly turn attention to the Nigeria economy. As it were, the IMF has put the global economic growth forecast to about 3.5%. Nigeria is expected to grow by 2.3%, you're aware. So how do you think we can position ourselves for this trajectory as a nation?
Just a little correction. Nigerian economy is expected to grow about 2%. It was the growth was downgraded from an expected 2.3% to 2%. And for 2020, the growth was downgraded from 2.5% to 2.3%. Back to how do we position for this growth, or how do we situate this growth? The reality is that the greatest challenge we have in growing the economy today is the weakness in the agricultural sector. The agricultural sector accounts for about 29% of the Nigerian GDP productivity. of productive activity in Nigeria, 29%. Agricultural sector is growing at 1.91%. So in effect, remember that third quarter the economy grew at 1.81%. Agricultural sector, which accounts for 1/3 of the economy, grew by 1.91%. In effect, the agricultural sector basically determines how the economy grows. If you cast your mind back to 2014, 2015, agricultural sector grew by 4.2%. Sorry, 4.11%. Then, by the time we got to 2016, it grew by 4.11. 2017, the agricultural sector growth slowed. We've seen the last year, 2018, the agricultural sector, let me correct it. By 2016, agricultural sector grew by 4.11%. 2017 first quarter, it grew by 3%. Second quarter of 2018, it grew by only 1.19%. And then fourth quarter, it grew by 1.91%. So dragging down economic growth rate to only 1.81%. To grow this economy, we need to do something immediately, and that is to arrest the level of insecurity in the northern part of the country. The three northern regions of the country are now engulfed in heightened level of homeland insecurity or internal insecurity, to the extent that we are having displacement of farmers in the north central, northeast, and northwest. And remember that the north basically accounts for the greater share of agricultural activity in the country. Yes. So we need to address that quickly. Then the other sectors we need to address is that we need to look at the level at which the industrial sector is growing. The industries account for about 9% of the GDP. The industries currently are growing at a very sluggish rate. And that sector is required to be stimulated. But to stimulate that, you need to address the issue of cost of funds and improvement in electric infrastructure. Supply of energy must improve. But that is the base, assuming no policies change. I also expect that when a government comes back or a new government takes over in May 2019, there are going to be major shifts in economic policies. Because without those shifts in economic policies, you are not going to see a sustained economic growth rate in the country. There's no reason, I always say this, why Ghana should be growing at a faster rate than the Nigerian economy, given the level of proximity between the two countries and the fact that the structure of the two economies are about the same. Agriculture accounts for 29% of Nigeria's economy. Agriculture accounts for a reasonable percentage of Ghanaian economy with mining. And then Ghana has now become an oil-producing country. Ghana, between 2010 and 2018, grew their economy at an average of 6.7%.
And that's very, very significant enough to.
And that is why when you talk about that the foreign direct investment is going to Ghana and more than what is coming to Nigeria, that's basically because investment goes to countries that have potentials of giving higher returns. For an economy that's growing about 6.7% year on year for 9 sustained years, and an economy that is now growing at 1.9, 1.7%, 0.82%, you can imagine where investors will go to. They will go to that country that has a stronger growth prospect, because that gives you an assurance.
But isn't this a kind of a question, kind of question mark on the diversification of the government in terms of agriculture and what they are doing in that sector?
You know, unfortunately, whatever government has done in the agriculture sector has been vitiated by the insecurity in that sector. Insecurity we're having in the north. Which is why I refer to the fact that in 2016, the sector grew by 4.11%.
That's right.
In 2017, we saw a decline in growth, and that decline has been sustained because we are seeing a wider spread in the level of insecurity. I'm not saying necessarily worsening in terms of intensity, but we're seeing a wider spread. So you saw at the earlier part of the current government term, insecurity was restricted largely to the northeast. we are now seeing displacement of farmers in the northwest. We've seen displacement of farmers in the north central. And overall, that has impacted in level of agricultural growth rate, irrespective of the effort the government is putting in to stimulate that sector. So we must address this issue of internal insecurity for you to have sustained growth. So when we talk of diversification works when there's an internal security, and then you have different sectors of the economy growing. But beyond the insecurity situation, there are a couple of things I would say that we need to do for us to begin to grow the economy on a sustainable basis. One is to address some of the leakages we have in the economy. Among the top leakages we have in the economy is fuel subsidy. I understand we're spending about 1.4 trillion naira on fuel subsidy. What we are subsidizing is consumption, not production. Appropriately, subsidy should be targeted at encouraging productive activities, not consumption. All right. So what we're doing in effect is that we're pushing out foreign reserve, we're pushing out jobs out of the country to other countries. That's one. We need to address that quickly. I've mentioned the issue of insecurity. We need to address it. Third, we must address the cost of funds in the economy, which means we need to drive down inflation rate and encourage lower cost of capital.
Well, I'm going to hold your thoughts there. When we come back, let's quickly take a break. When we come back, we'll talk more about especially this area you just mentioned that has to do with policy and all of that. We'll be back in a moment. Join us again. Glad to have you back now. Let's continue the conversation here. Johnson Chukwu, CEO, Cowry Assets, is still here with me. Thank you for your time on the program. Now, let's quickly turn our attention to the government policy, the fiscal policy, and the monetary policy. Those who have argued that the government, especially the present administration, is not getting it right or has not gotten it right at all in these areas. How do you think we can address this? Or what are your views? Let me put it that way.
Well, you mentioned the issue of monetary policy and fiscal policies. The monetary policy is basically the responsibility of the monetary authority, which is basically driven by the central bank. What we've witnessed in the past couple of years is some fiscal vacuum. That is some level of inertia on the side of the fiscal policies, and that's what most people have complained about. If you remember, the central bank governor had a different fora mentioned the fact that the fiscal authority needs to step up their act so that to make monetary policies more effective. When you talk of fiscal policies, the greatest fiscal policy tool is a budget, national budget. Interestingly, in the past 3 years, we've seen the national budget, the federal government budget approved around May or June and signed into law more than half of the year gone. And today, we also seen that disbursement or implementation of the budget have in most times been less than 50%. So in reality, that the effectiveness of fiscal tool have been weakened by one, late approval of the budget, two, slow or very low implementation of the budgets. And this is the strongest tool that the government needs to use to intervene or stimulate the market, the economy. And this 2019 doesn't seem to be likely going to be different from what we see in the past years. Currently, we know that featured members of the National Assembly on the election train. So the likelihood that the budget will be passed into law before the end of the first quarter of this year is very slim. I'm not even sure that the budget will be passed into law before the end of the second quarter of this year. By then, half of the year would have gone. And the capacity of that budget to be used as an effective tool for driving economic development will be weakened. So that's the challenge we've had. The government has come up with different commitments on when the budget could be passed, but unfortunately, they don't seem to have remained faithful to those commitments. We saw 2019 budget presented to the National Assembly in December, just a few days before they proceeded on their Christmas and New Year holidays. And that, be that as it may, we're now seeing the implication that it is not likely going to be passed into law soon. In the absence of the budget, then the capacity of the executive arm of government to drive economic activities are weakened. There are still other tools they can use. Tools like subsidy, which I mentioned earlier. The subsidy, unfortunately, is wrongly targeted. It's targeted at consumption, and consumption of products we don't produce locally. You can, if you have to stimulate an economy through negative tax, which is what they call subsidy, another name for subsidy, negative tax, then it must be targeted at consumption of products that you produce locally, if it must be targeted at consumption really. And unfortunately, our target of refined petroleum product subsidy is targeted at the product we have to import. So what we do is encourage additional importation of a product you do not refine locally. And as we all know, basic economics teach us that import is a leakage and export is an injection. So as long as you continue to import a product, as long as you continue to subsidize a product you do not produce, you are actually encouraging leakages in your economy. So that's one tool that the government could have used. The other tool is taxation. In fact, taxation, like I mentioned, even subsidy is what they call negative tax.
Let me quickly take you back to the issue of budget. How do you think we can address that, what is seemingly becoming a culture where the budget has to be approved late into perhaps half of the year it's gone before we can? How do you think we can? Is it because we're seeing a relationship between the executive and, of course, the National Assembly?
Well, there are several things that have to be done. I try to mention some of them. One is starting from those who prepare the budget. They need to understand the budget preparation process. A lot of people who prepare the budget do not even understand how to prepare budget. So there has to be one from the point of knowledge. The Ministry of Budget and National Planning must have the competencies to do the budget, and they must spread the knowledge or pass on the knowledge to the budget officers in all the ministries, agencies, and departments. Two, we must go back to the Fiscal Responsibility Act. There are timelines for preparation and submission of the budget. I think the budget must be submitted to the National Assembly by October or thereabouts, which means the budget preparation process, which including sending out the budget circulars, should start somewhere around July. So by the time you have August, the ministries will have come back to the relevant Ministry of Budget to start collating. And then the interaction between the Ministry of Budget and the individual ministries and departments would take place and be concluded before the budget goes to the National Assembly. Second important factor is that the members of the National Assembly must be carried along in the preparation of the budget, so that instead of dealing with what we call constituency projects, whatever input they have to make into the budget should be sent to the relevant ministries who will incorporate that into their budget preparation process, so that it will now fit into a whole. Because when you have, what we have now is so disjointed that the document gets to the National Assembly, the National Assembly begins to insert projects into a budget, not factoring the fact that the budget would have to be funded, and then there's no provision for them to raise the capital to fund the budget. So that level of interaction, particularly if the same party controls the executive and the legislative arm of the government, there must be a certain higher level of consultation and engagement between the two arms of government. If you do that, you're likely going to eliminate the iterations and back and forth movement that go on when the budget comes to the National Assembly. And like I said, if the budget officers are fully aware, then it's easier for them to go to the National Assembly when they are called in to defend their budget, so to defend such input which they have prepared. And then the government must adopt the issue of zero-based budgeting. Zero-based budgeting will eliminate inefficiencies and ensure we get value for money on budgetary items. Because if you continue with incremental budgeting, what happens is that budget officers come and add additional money based on the previous year's amount that we are budgeted, but does not consider whether the absolute necessity of that item in the budget. So we need to adopt those three things. One, issue of knowledge or competence in terms of those who prepare the budget. Two, higher level of engagement between the executive and legislative arm of government. And three, we must go to zero-based budgeting to justify every component or every item that's inputted in the budget.
The first, of course, I want us to talk about the deficit side of the budget. Of course, we've seen that some people have the 2018 appropriation bill had about over 2 trillion naira in terms of servicing the deficit, and of course we've seen that again, that trend continuing in the 2019 budget. Of course, the recent CBN, that's about just 2 days ago, we had CBN in their Monetary Policy Committee meeting saying that, or warning the government to check the rate at which they borrow in financing some of the infrastructure, and of course also servicing the deficit as well. And so how do you think we can address this? Though of course the government has said it is sustainable, that borrowing is sustainable. But you as an economist and of course in the market, how sustainable it is from your own risk analysis?
Well, I think continuous borrowing is not sustainable. Current debt is sustainable. Current debt level can be managed, but to increase the level of borrowing, which is sustained borrowing, which I have to use the word of sustained borrowing, is not sustainable, which is what the central bank wants. Today, our national debt, if you add the $2.86 billion that was borrowed in November from the Eurobond market, our national debt should be something in the neighborhood of $76 billion. Yes. Our GDP today is about $376 billion, which means about 20% of our GDP is what the current debt accounts for. When you add private debt, you come to about 36% of the GDP. If you look at that as a percent of GDP, it doesn't send an alarm bell. Right. But what sends an alarm bell is when you look at the debt service to revenue. Our debt service to revenue has breached the 60% mark. We're heading towards 70% debt service to revenue.
And this is alarming.
And that's alarming. Well, what that means is that for every 1 naira that the government earns, 60 or 65% it goes, 66% goes to pay debt, to pay interest on debt, not to pay back the principal, which leaves you with 33% for you to meet the recurring expenditure of the government, to meet the capital expenditure of the budget, which is what you need for economic development. In effect, if the government does not borrow, as it stands today, the government is not in a position to even meet its recurrent expenditure.
So it has to continue to borrow.
So the government now has to continue borrowing to service debt and meet recurrent expenditure obligations. And that is where the problem is. Because if you look at the 2019 budget, recurrent expenditure is about 4 trillion. Debt service is about 2 trillion. Total revenue is just about 6 trillion. That does not include, when you factor in the capital expenditure budget, then you realize that, look, without borrowing, the government cannot even meet its basic obligations.
But isn't this risky in terms of growing the economy, in terms of fiscal plan, policy and planning? I'm looking at the current economic trajectory or growth.
Yeah, well, that's why I said that. I always say is that look, if the government continues with the current policy environment, the economy is not going to develop, it's not going to grow.
Are there ways we can begin to generate funds? The government should begin to look away from borrowing, generating funds to finance its deficit.
Absolutely. That's why I had mentioned one of these key elements that let's take out the leakages. I had mentioned that we could save 1.4 trillion naira by eliminating subsidy. When you take that away, you will automatically it will adjust your revenue and expenditure profile. It will also adjust the proportion of your recurrent expenditure as a percentage.
But wouldn't that have a very immediate effect on the Nigerian, of course, the masses on the streets?
Yeah, I will come back to that. Yeah. Second factor, the government cannot continue to fund infrastructure from budgetary allocation because we don't even have the resources to fund infrastructure. We have very limited revenue. If you look at the budget for this year, just about $14 billion. So the government does not have the revenue to fund infrastructure. So if you look at the level of infrastructural gap that we have today, we need to evolve public-private partnership. Where at the minimum, the government should bring private sector to fund those infrastructure that are commercially viable. That will eliminate the burden of those particular infrastructure. And then we open up the economy for expansion in the productive activities, which will help to grow the economy. And one of the key examples that I always use that. Today, the government is talking about that is building the second Niger bridge. For me, there was no need for the government to spend budgetary allocation on the second Niger bridge because previously, that second Niger bridge had been concessioned to Julius Berger and Nigerian Sovereign Investment Authority to build under private-public partnership. And under that arrangement, the government was supposed to pay close to nothing. A little amount that the government was supposed to pay as its own contribution to that project. By now, that project would have been finished. The road would have been tolled because there's an alternative route. So if you want to stay on the old bridge and avoid toll, you stay on the old bridge. But if you're in a hurry, you take the commercial corridor and pay and have smooth access. That would have been built. I also think there are a couple of road highways in the country that can go to the private sector. The Lagos-Ibadan Expressway, we've been building it for the past couple of years. There's no reason why the Nigerian government should continue to fund the Lagos-Ibadan Expressway from budgetary allocation because we don't have the money. Private sector could have built a new corridor on that route and the government will maintain the old corridor. And those who are in a hurry, who are ready to pay, would have taken the new corridor. Because it's a commercially viable route, the investors will build it. Look at the rail lines. The standard gauge rail from Lagos to Kano, about 130 kilometer standard gauge rail. The budget that was made in 2006 was about $8.3 billion. If you concession that to a private sector operator, they will build it, get a rolling stock, and then run that efficiently. The Lagos coastal rail line is also a commercially viable route. Any route that goes from Lagos goes through Onitsha and Aba will be commercially viable. That will also open up the economies of this along this corridor, grow the economy, expand productive activities, and then the government will be in a position to even generate higher tax revenue. So key thing is this: we need to bring in private capital into building infrastructure. The concept that the government will continue to fund infrastructure in piecemeal from budgetary allocation that they can barely afford. Even when we do that, we're going to see a growth in the GDP. The effect of the existing debt will reduce. Government ability to earn tax revenue will also increase, and the government will be in a position to even expand and on those capital infrastructure that are not commercially viable, that can only be done by the government.
Let's wrap it up now. The global oil price is risen, in recent times, and we've seen a bit of hope in the crude oil market. So, do you see a decline soon? Since, of course, the budget, the benchmark in the 2019 budget is at $60 US. Of course, that has been threatened in recent weeks before we start seeing a surge in that market.
Well, I think we may not see a significant decline in the price of crude in the immediate future. We saw a precipitous drop in the crude price, but which has recovered. We have seen sustained willingness of Saudi Arabia to cut down production, to sacrifice its own production for the interest of the cartel, of crude price. We've also seen a high level of cooperation between Russia and the OPEC members. We just saw that the OPEC members recently reduced their production quota so as to improve the price of crude. Unless you see a major decline in world economic productive activities, I do not imagine that crude price could drop drastically. We've seen America gone to become the largest crude producer in the world, but they have also retained the #1 crude consumer in the world. Currently, U.S. is producing about 11.76 million barrels a day, ahead of Russia, with Saudi Arabia coming third. So, in effect, I also want to believe that the capacity of the U.S. to add additional barrels of crude in million times will be constrained, given where they've gotten to now. So, in the absence of, you did mention earlier that the World Bank is projecting the global economy to grow about 3.6% in 2019, and 3.5% in 2019, and 3.6% in 2020. So, such level of growth, I want to believe, will make for oil price to remain in the region of $54, $55 to something like $65, $70. And that has been the projection among different entities that predict the crude price. So I think the challenge we'll have will not necessarily be the crude price. The greater challenge we have is that we sustain the peace or the level of moderate stability we have in the Niger Delta. And that can only be sustained if we have a free and fair election. So there are no fresh reasons for agitation among the Niger Delta militants. Should you have a hung election or an unacceptable outcome from that election where people feel their votes were not respected, you could have a situation where passions would flare up and the crisis could also resume in the Niger Delta. That is where the greatest challenge we have will relate as it relates to our revenue from oil.